What we're about to discuss isn't a prediction about tomorrow's price movement. It's an honest assessment of where we are in a much larger financial cycle and what that honestly means for your wealth and your decisions. If you're watching this, you likely already sense something has shifted. The financial news cycles feel more fractured. Central banks are behaving differently than they did even a year ago, and the asset that sits quietly in many investment portfolios, silver, is starting to show signs we haven't witnessed in nearly a decade. But here's what matters. Before we talk about what may happen, we need to understand why it happens. Because the real knowledge isn't in predicting the next move. The real knowledge is in understanding the system well enough that when the move comes, you're not surprised. You're prepared. This is a conversation for anyone who holds silver, anyone who's been skeptical of silver, and anyone who's wondering whether they should care at all. Let's talk honestly about where we are. For the past several years, silver has occupied an unusual position in the financial landscape. It's been ignored by most mainstream investors, dismissed by some as a speculative relic, and followed closely by a smaller group of people who've studied monetary history and inflation dynamics closely. That imbalance, that gap between those who understand its role and those who don't, is part of what creates inflection points. But let's be precise about what's actually changed. The global debt expansion over the past 15 years hasn't slowed. If anything, it's accelerated. When we look at total global debt as a percentage of GDP, we're at levels that require either sustained growth, which is unlikely, or currency expansion to service. And currency expansion has a particular consequence that most investors don't sit with long enough. It changes the purchasing power of the currency itself. This isn't theoretical. It's happening in real time. Central banks, after spending 2 decades managing inflation downward, have suddenly reversed. They've expanded money supplies at rates not seen since the immediate post-2008 period. The Federal Reserve, the European Central Bank, central banks worldwide, they've all pumped extraordinary amounts of liquidity into the system. And while that liquidity initially went into financial assets, stocks, bonds, real estate, it inevitably finds its way into the real economy. When it does, 2 things happen. First, the people holding financial assets often benefit early. It's called the wealth effect, and it's deliberate policy. Second, the people holding cash or earning fixed wages slowly lose purchasing power. And third, and this is where silver becomes relevant, the people who hold commodities and physical assets begin to outperform. The reason this matters now is timing. We're at a point where 3 forces are aligning simultaneously in a way that rarely happens. The first force is inflation that's broader than financial markets. When inflation was purely in stocks and bonds, when it was inflating asset prices but not consumer prices, the central banks felt they had room to maneuver. They could point to low official inflation numbers and continue their policies. But something changed. Inflation in real goods, energy, food, labor, housing, became too visible to ignore. Governments were forced to acknowledge it. And once inflation becomes acknowledged as a real problem, the psychology of investors shifts. They begin to remember that commodities and hard assets exist as a hedge. They begin to recall that in every inflationary cycle in history, precious metals have played a particular role. The second force is the shift in central bank behavior itself. For decades, central banks were net sellers of gold and other hard assets. They were moving toward fiat-only portfolios. That trend has reversed. Over the past 5 years, central banks worldwide have become net buyers of gold. They've been accumulating it in a way that signals they understand something about the long-term viability of fiat currency that they're not saying openly. Why would central banks buy gold if they believed their own currencies would remain strong? They wouldn't. The fact that they're buying sends a signal to the entire financial system. It's not manipulated into headlines, but if you're paying attention, it's there. The third force is what we might call the retail awakening. For the first time in a generation, younger investors and everyday people are asking fundamental questions about currency. They've watched inflation erode their savings. They've watched asset prices, particularly housing and stocks, move faster than their wages. And they've started, quietly but persistently, to ask whether there's an alternative to simply holding currency and hoping. This isn't new in history, but it's new in a world where information travels instantly, where retail investors have direct access to markets, and where the ability to buy or hold silver has never been easier. Before we go further, let's address something directly. Most people who are skeptical of silver as an investment are operating from one of 3 misunderstandings. The first misunderstanding is that silver is primarily an industrial metal. Technically, this is true. A percentage of silver consumption is industrial, but this framing misses the fundamental point. Silver's price is determined not by industrial demand alone, but by financial demand. When investors begin to see silver as a store of value, as a hedge against currency depreciation, the price stops being determined by how many solar panels need silver coating. It becomes determined by how many people want to hold it instead of cash. This distinction matters enormously. Industrial demand is relatively stable. Financial demand is variable and cyclical, and we're entering a phase where financial demand is awakening. The second misunderstanding is that silver doesn't have intrinsic value. This argument comes from a particular school of thought that says only currencies backed by government or digital ledgers maintained by consensus have real value. But that's a philosophical position, not an economic one. Silver has been used as a medium of exchange for thousands of years. It has consistent physical properties. It's divisible, it's portable, it's durable. These aren't qualities that change based on what financial theorists say. They're properties of the material itself. The third misunderstanding is about volatility. Many investors look at silver's price history and see swings, sometimes dramatic ones, and conclude that it's too risky. But this view confuses volatility with risk. Volatility is price movement. Risk is the probability of permanent loss of capital. If you own silver and hold it in your possession or in genuine vaults, the risk of permanent loss is relatively low. The volatility, the ups and downs, are opportunities for people who understand the longer cycle. Understanding the difference between these concepts is where disciplined thinking begins. We don't need to speculate about how silver behaves during currency stress. History has shown us repeatedly. In the 1970s, when inflation ran into double digits and the US dollar was being questioned, silver moved from roughly $1.50 per ounce to over $50 per ounce by 1980. This wasn't because silver had any new industrial use. It was because people were losing faith in currency. They were looking for something, anything, that couldn't be printed by a central bank. In the 2000s, when the housing bubble was inflating and central banks were loosening policy aggressively, silver moved from roughly $4 per ounce to nearly $50 by 2011. Again, this wasn't about industrial use. It was about monetary expansion. In both cases, people who understood the macro cycle early had time to accumulate. People who waited until mainstream media was talking about it were buying late in the move. People who understood the cycle's end were able to step aside before the corrections came. People who didn't understand it often held all the way down. The pattern isn't about prediction. It's about recognizing the conditions. When currency is being expanded rapidly, when inflation is visible, when central banks are purchasing hard assets themselves, when retail investors are asking questions about alternatives, these conditions have historically preceded significant moves in precious metals. We've seen these conditions before, and they've led to particular outcomes. Not guaranteed outcomes, but outcomes that were more probable than other scenarios. Now, here's where we need to be honest about human nature and how markets actually work. Markets aren't moved by facts alone. They're moved by psychology. And psychology moves in cycles. For the past decade, the dominant narrative in investing was that you should own stocks and real estate, hold minimal cash, and forget about commodities. Precious metals, in particular, were treated as relics, something your grandfather held, not something a sophisticated investor bothered with. This narrative was reinforced by central banks actively stating their intention to keep inflation low. It was reinforced by technology and efficiency gains that genuinely did keep many consumer prices low, even as asset prices inflated. And it was reinforced by the simple fact that during this period, stocks and real estate outperformed commodities. When something outperforms, people naturally gravitate toward it. But here's the crucial point. That narrative is shifting. And it's shifting not because the truth changed, but because conditions changed in a way that made the narrative untenable. When central banks can no longer credibly claim inflation is temporary, when central banks themselves start buying gold, when inflation becomes too visible to ignore, people begin to question the narrative. They begin to think about alternatives again. And when enough people simultaneously begin thinking about alternatives, markets move. This isn't greed or irrationality. This is basic psychology. When circumstances change, thinking changes. And when thinking changes, behavior changes. And when enough behavior changes, prices change. The fact that this cycle is now beginning is what makes this moment significant. Not because silver will definitely spike, but because the conditions that historically precede spikes have materialized. Let's talk about the elephant in the room: government debt. Global government debt has expanded to levels that are mathematically difficult to service through growth alone. The US runs persistent deficits. Most developed nations do. This debt doesn't simply disappear. It gets financed. And as it gets financed, it puts pressure on currency systems. Now, governments have several ways to solve a debt problem. They can raise taxes, they can cut spending, they can default, or they can devalue the currency. Each has political consequences. Which one do you think elected officials find most acceptable? Throughout history, when debt becomes overwhelming relative to economic output, the path of least political resistance has been currency devaluation. Not openly, not as a stated policy, but as a result of doing what seems expedient in the moment. Currency devaluation means your currency buys less. It means the purchasing power of cash erodes. And the assets that have historically preserved purchasing power through currency devaluation cycles are commodities, particularly precious metals. This isn't a claim about what will happen. This is an observation about what has happened repeatedly in history. And right now, the conditions that typically precede currency pressure are present: large deficits, large debt levels, central banks expanding money supplies, and inflation that's becoming difficult to deny. For a long time, keeping money in the bank or in government bonds made sense. If you held a savings account paying 3% and inflation was 2%, you were ahead. Your money was safe and earning real returns. That's not the case anymore. Today, interest rates are below inflation. If you hold cash paying 1% and inflation is running at 3 or 4%, you're losing purchasing power. Your money is safe in the sense that it won't vanish, but it's not safe in the sense that it's preserving your wealth. This is a fundamental shift. When real returns become negative, when holding cash means losing purchasing power, people naturally ask what else they could hold instead. The answer has historically been hard assets: real estate, commodities, stocks, precious metals. Silver is one answer to that question. It's not the only answer, but it's an answer that has particular relevance during currency stress because it can't be printed. Its supply can increase only by mining it. And mining takes years, requires capital, and is constrained by geology. In other words, when you hold silver, you're holding something whose supply can't be expanded by committee vote. That's a particular feature that becomes valuable when currency is being expanded aggressively. If you're watching this and you already have silver, whether you hold it yourself, in a vault, or in some other form, let's talk about what this means for you in practical terms. First, this is not a signal to panic sell or to suddenly buy more. If you've held silver through the past decade of relative quiet, you've been disciplined. You probably held it because you understood the monetary system and wanted insurance against the scenario we're now approaching. Stay with that discipline. What's changing is that the scenario you were insuring against is becoming more probable. You held silver in quiet years as a hedge. You're holding it now as conditions are aligning that make that hedge more relevant. This is exactly the position you wanted to be in. You're not starting from zero. You're not panicking. You're simply watching the scenario you prepared for develop. The psychological challenge for people who already hold is different than for people considering entry. Your challenge isn't whether to buy. Your challenge is managing the emotional volatility that typically comes with these moves. Silver can move dramatically when financial demand awakens. You might see moves up, then pulls back, then new highs. This will test your conviction. Here's what to remember. The scenario you were hedging against isn't resolved simply because silver moved up. If you bought silver because you understood inflation dynamics and currency risk, those conditions are still there even if the price doubles. Don't mistake a price move for resolution. The macro cycle is still unfolding. This means don't sell every ounce the moment there's a move. Don't assume the move is complete. Don't chase more on FOMO. Stay disciplined. You already have the position. Your job is to hold it through the cycle and to resist the emotional pulls of greed and fear. One practical note: if you've accumulated silver and you're holding it yourself, ensure you have adequate security. If it's in vaults, ensure those vaults are legitimate and you actually have title to the metal. This isn't paranoia. It's basic due diligence. During volatile periods, the details matter. Now, if you're watching this and you don't hold silver but you're wondering whether you should, let's be honest about what you're considering. You're not considering a quick trade. If that's what you want, stop reading now. That's not what this is about. If you're thinking about silver in the context of this macro cycle, you're thinking about a position that might take months or years to materialize. You're thinking about something you might hold through volatility. You're thinking about portfolio insurance and wealth preservation, not trading profits. So the first question to ask yourself is, am I comfortable with that? Am I comfortable buying something that might go sideways for months? Am I comfortable watching it move against me temporarily? Am I comfortable holding something that isn't generating income? If the answer to those questions is no, then silver probably isn't for you. There's no shame in that. Not every investment is for every investor. Your time horizon and emotional tolerance matter. If the answer is yes, then the next question is, how much should I allocate? This is where discipline becomes essential. Don't use leverage. Don't bet the farm. Don't allocate more than you can afford to hold without stress. Most serious wealth builders who've studied this recommend allocating somewhere in the range of 3 to 10% of a portfolio to precious metals. Some go higher. But the principle is the same. It should be a position you can hold comfortably even if it moves against you. The reason for this discipline is simple. If you're holding something as insurance against currency stress and that stress actually materializes, you want to be able to hold it without panic. If you've allocated too much, you'll panic sell at the worst time. If you've allocated reasonably, you can hold and even add if conditions continue to deteriorate. Here's another practical point. Consider how you want to hold silver. You have options. You can buy physical silver, coins, or bars, and hold it yourself. You can use a vault service. You can buy silver through ETFs or funds. Each has trade-offs. Physical means you have direct possession and no counterparty risk, but it requires secure storage. ETFs mean you don't have to store it, but you're trusting the fund to actually hold the silver. There's no universally perfect answer, but there is a right answer for you based on your circumstances. Think about it honestly. One more thing for potential new buyers. Dollar cost average your way in. Don't try to catch the bottom. Don't wait for the perfect price. Over a period of weeks or months, accumulate a position. This accomplishes several things. It reduces the odds that you buy everything at the top of a move. It gives you time to think about whether you're actually comfortable with this decision. And it takes the pressure off you to be right about timing. Remember, the goal isn't to maximize profits. The goal is to preserve wealth during currency stress. You can do that perfectly well by buying steadily over time at whatever prices you encounter. Let's be very clear about behaviors to avoid. These aren't theoretical. These are behaviors that destroy wealth and cause people to regret decisions. First, don't leverage. Don't buy silver with borrowed money. Don't use margins or futures unless you have professional expertise. Silver can move dramatically, and if you're leveraged, dramatic moves can wipe you out. The goal of holding silver is insurance, not speculation. Insurance doesn't require leverage. Second, don't chase headlines. During the coming volatility, because there will be volatility, you'll see sensational headlines about silver. Silver breaks all-time highs. Shortage imminent. Experts say this could hit $200. Ignore this. Headlines are designed to create emotional reactions. They're not investment advice, they're noise. Dismiss them and stick to your plan. Third, don't follow online influencers blindly. Yes, there are people online who understand silver and monetary cycles, but there are also people online who are pumping silver for their own reasons. Some are trying to drive prices up so they can sell. Some are trying to build followings by being sensational. Some are simply confident without actually knowing what they're talking about. Don't follow anyone blindly. Develop your own understanding and make your own decisions. Fourth, don't abandon your entire portfolio strategy because of conviction about silver. If you understand the macro cycle and you're excited about precious metals, that's fine, but don't liquidate every other holding to go all in on silver. Diversification exists for a reason. You can have conviction about silver and still maintain a balanced portfolio. Fifth, don't panic sell during correction. When silver moves up, there will inevitably be a pullback. That's how all markets work. Some people will see the pullback as a sign that the move is over and they should sell. They'll lock in losses. Then the move will resume higher and they'll feel foolish. This pattern repeats throughout history. Be aware of it. Don't be a victim of it. If you bought at $20 and it goes to $30, a pullback to $26 is not a signal to sell at a loss. It's a normal part of the cycle. Sixth, don't tell your friends to buy without being prepared for what happens if they buy at the wrong time. If you recommend silver to people in your life and they follow your advice, they need to understand they're making a long-term commitment. If they buy and the price pulls back, they'll blame you. Make sure they understand what they're committing to before they commit to it. Seventh, don't ignore global context. Silver is traded in dollars, but it's traded globally. If the dollar suddenly strengthens against other currencies, that can put pressure on dollar-priced commodities like silver. You don't need to predict currency moves, but you should be aware that they matter. And finally, don't mistake rising prices for success. If you allocate to silver because you understand monetary cycles and then the price rises, that's nice. But it's not the point. The point is that you're preserving purchasing power. If inflation is running at 5% and silver is up 15%, you're outpacing inflation and that's good. But if silver is up 50% and inflation is 0%, you've been a speculator, not an insurance buyer. Understand the distinction and measure your own success by whether you're actually preserving wealth relative to inflation, not just whether the price is going up. Let's address something directly. The next few months or years will likely include significant volatility in precious metals, possibly in markets generally. This volatility isn't a bug, it's a feature. It's what happens when markets are repricing assets based on changing assumptions about the future. You should expect it. You should prepare emotionally for it. How do you prepare? By understanding that volatility is information. When silver moves dramatically up, it's telling you something about changing psychology and demand. When it moves dramatically down, it's telling you that some investors are taking profits or that macro conditions temporarily shifted. Neither move means you should panic. They both just mean the market is doing what markets do. Think of volatility as the price of getting the insurance benefit. If you want to preserve wealth during crisis, you have to accept that the thing you're holding won't behave like a stable bond. It will move. That movement is information, not a reason to sell. The people who successfully navigate volatile markets are those who have a plan before volatility starts. So develop your plan now. Decide what your allocation will be. Decide how you'll hold it. Decide under what conditions you might add more. Decide under what conditions you might sell. Write it down. Put it somewhere you can refer to when emotions are high. This is discipline. And discipline is the difference between people who build wealth and people who don't. To understand why this moment matters, we need to zoom out and see the larger context. For decades, the dominant financial system has been one where central banks manage outcomes through currency expansion. When there's a crisis, they expand. When there's economic slowdown, they expand. This model worked, or at least appeared to work, because the expansion could be absorbed into asset prices without causing consumer-level inflation that was too politically damaging. But we've reached a point where that model is straining. The expansion is now visible in consumer prices. People are feeling it. Central banks can't simply pretend it's not happening. And investors are beginning to question whether a system that requires endless expansion can actually work forever. This questioning is at the heart of why alternative stores of value are becoming relevant again. For a long time, holding alternatives to currency seemed paranoid. Now it's starting to seem prudent. This doesn't mean the system collapses tomorrow. It might not collapse at all. Systems are remarkably resilient, but it does mean the system is changing. And in periods of change, the assets that do well are often those that don't depend on the system continuing exactly as it has been. Silver is one such asset. It doesn't depend on stock markets staying calm. It doesn't depend on interest rates staying negative. It doesn't depend on deficits being sustainable. It just depends on people wanting to hold something of value. And when currency is being questioned, people want to hold something of value. That's not a prediction. That's an observation of historical pattern. Here's something that separates people who succeed with alternative assets from people who don't: patience and long-term thinking. The financial system doesn't change overnight. Currency doesn't collapse in a day. These processes take time. You might buy silver and watch it sit quietly for 6 months or a year while the macro scenario slowly unfolds. You might think you made a mistake. Then suddenly conditions accelerate and the asset moves decisively. This is the actual experience of most successful investors. They're not right quickly. They're right eventually. And they're right because they held on while others got frustrated and sold. Long-term thinking means not judging your decision by what happened last week. It means not reacting to headlines. It means holding a position because you understand the reasoning behind it, not because you think something is about to happen. If you buy silver now and nothing dramatic happens for 2 years, that's fine. You're still holding insurance. If something dramatic does happen in 2 years, your insurance becomes incredibly valuable. Either way, you held the position for the right reason. This is how patient capital works. It's not glamorous, it doesn't make good YouTube videos, but it's how wealth is actually built and preserved. Finally, let's talk about how to stay informed about these developments without being swept into emotional extremes. Stay informed by reading. Not blogs or social media, but actual analysis. Read about monetary history, read about inflation cycles, read about how previous financial transitions happened. This knowledge gives you a framework for understanding current events. Stay informed by watching central bank actions, not central bank words. What are they doing? Are they buying gold? Are they expanding money supplies? Are they changing their inflation targets? Actions reveal intentions in ways that words don't. Stay informed by paying attention to real-world prices. What are energy prices doing? What are housing prices doing? What's inflation actually running at for people who live real lives? This grounds you in reality rather than in academic theories. But don't stay informed by checking prices every hour. Don't stay informed by reading every commentary about where silver could go. Don't stay informed by social media. That's not staying informed. That's becoming emotionally reactive. There's a balance. The balance is understand the macro cycle, make a decision based on that understanding, execute a plan based on that decision, and then step back. Don't micromanage. Don't react to noise. Don't second-guess yourself daily. This is harder than it sounds because the culture of investing has become one of constant activity and reaction. But it's the approach that actually works. Here's something that won't make headlines, but is profoundly important. The best investment decision you can make is to educate yourself. If you understand how money works, how central banks operate, how inflation functions, how cycles develop, you'll make better decisions than most people. Not because you're smarter, but because you understand the systems you're participating in. Most people investing in financial markets don't understand monetary systems. Most people holding currency aren't aware of what's happening to its purchasing power. Most people watching central banks make decisions don't understand why those decisions are being made. This ignorance leaves them reactive. They respond to what's happening rather than understanding what's happening. Education changes that. When you understand the system, you stop being reactive. You become proactive. You make decisions based on understanding rather than fear or greed. How do you educate yourself? Read history. Read monetary economics. Read about past financial crises and how they unfolded. Understand that what's happening now isn't unprecedented. It's a pattern that's repeated many times, and the patterns have historical precedent. This doesn't require complex mathematics or secret knowledge. It requires curiosity and discipline. It requires being willing to read things that are challenging. It requires questioning narratives you've been told. Do this work before you make decisions about silver. Do this work regardless of whether you decide to buy. This education will serve you throughout your investing life. As we wrap this up, let's be clear about something. Having conviction about the macro cycle and positioning yourself accordingly isn't extreme. It's prudent. For most of history, holding some portion of wealth in real assets, particularly precious metals, was completely normal. The idea that you should hold only fiat currency is actually the recent experiment. And that experiment is showing stress. Returning to a more balanced approach to wealth storage isn't paranoia. It's not extremism. It's actually just returning to what worked for centuries. The fact that mainstream finance talks about precious metals as relics or speculation says more about the current moment than it does about silver itself. In 50 years looking back, the current dismissal of precious metals might seem as quaint as the dismissal of stock investing seemed in 1920. You don't need to have perfect timing. You don't need to catch the exact bottom or sell at the exact top. You just need to understand the cycle and position yourself sensibly within it. If you understand what's happening in the monetary system, if you recognize the patterns from history, if you've positioned yourself with discipline and patience, then you're not gambling. You're investing. You're not speculating. You're hedging. You're not following hype. You're following logic. That's empowering. That should feel solid. We're at an inflection point. Not because silver is suddenly going to be valuable. It's always been valuable. But because the conditions that have historically preceded significant moves in precious metals have aligned. Central banks are buying. Inflation is visible. Currency is being questioned. Retail investors are asking questions. The narrative is shifting. What happens next isn't predetermined. Markets are never predetermined. But the probability that precious metals will become more important to portfolio strategy than they were 5 years ago seems high. The probability that being positioned before that shift happens is more valuable than being positioned after seems logical. You don't need to bet everything on this outcome. You don't need to panic about your current holdings. You don't need to do anything dramatic. You just need to be thoughtful. You need to educate yourself. You need to understand the systems that affect your wealth. You need to make decisions based on logic rather than emotion. And you need to remember that throughout history, the people who did well during financial transitions were those who prepared during the calm before the transition happened. They didn't get rich quick. But they weren't devastated either. They preserved and then grew their wealth because they understood what was coming and positioned accordingly. That's what's available to you. Not guaranteed wealth, not quick profits, but the opportunity to be thoughtful and positioned when the system changes. That opportunity is what this moment offers. The question is whether you'll take it. Thank you for spending this time with us. Think carefully about what you've heard. Talk to people you trust. Educate yourself further. And make decisions you can stand behind. That's what intelligent wealth management looks like.